For this class, we continue with the program. And yesterday we were talking about accounting for financial assets. And we have seen that there are different measurement categories, how to value those financial assets. We have fair value through profit or loss. We have amortized cost, or we have fair value through OCI. In order to determine which measurement method to use, we have to apply this decision tree if we talk about debt instruments. So I need to check if there are SPPI, so simple, and which business model the company pursued or pursues by holding this asset. And for equity, it's fair value through profit and loss, except for the option to use fair value through OCI. Okay. And then we did this first case, how to measure assets at fair value through profit and loss. Well, it's rather simple, because on the asset side, you simply value upwards or downwards your financial instrument, and all gains and losses that you recognize here on the asset side are put immediately in the income statement. That's why it's called fair value through profit and loss. Now we will continue and talk about fair value through OCI. Okay, well, we know OCI is the item in equity, not in the income statement, where I recognize certain gains and losses. Well, here we have one category of those gains and losses, those that relate to certain financial assets. Remember, fair value through OCI can be used for equity instruments that are not for trading, not speculative, and they can be used for debt instruments that are SPPI, and where the business model is to collect contractual cash flows and sell the asset later. Okay, so all fair value changes are recognized in other comprehensive income, except for interest and dividends that go in the income statement, impairment losses, we talk about this a little bit later, and eventually foreign exchange gains and losses that relate to those financial instruments. And then we have this question of recycling, okay, which I explain a little bit later. Actually, right now, when we do an example regarding this fair value through OCI accounting. Okay, so I buy bonds for 150,000 with the purpose to collect interest and sell the bonds. So here it seems to be a regular bond that is SPPI. The business model is to collect interest and sell the bonds. So we are in this business model where I must use fair value through OCI. At the end of the first year, the fair value of the bonds is 170,000. At the end of the second year, the fair value is 165. And at the beginning of the third year, I sell those bonds for 167. Okay, so what are my accounting entries here, excluding the interest payments that we do not consider here? Okay, so 150 purchase price. Well, that means I start on February 1st with a cash outflow of 150,000. By the way, you have empty slides because you have the student versions of the slide. Obviously, when the course is over, I will put you on Canvas, the professor version of the slides with all the solutions. So here I spent cash 150,000, and I recognize a financial asset. It's probably a non-current asset because I will keep it for more than 1 year. At the end of the year, December 31st, the portfolio value is 170. Okay, so that means on the asset side of the balance sheet, I need to recognize this value increase. And since we are in the category fair value through OCI, well, the plus 20,000 are not recognized in the income statement, but they're recognized directly in equity in OCI. So plus 20,000 here. Okay, and then we are good. At the end of the second year, December N+1, the portfolio value has dropped down to 165,000. Okay, well, that means on the asset side, I need to decrease the value of my asset by 5,000. And now we see the portfolio value of 165. And gains and losses go in OCI. Okay, so that means here also the 5,000, I put them directly in equity. So we see here for the first 2 years, no impact on the income statement, which means also, remember yesterday my last comment, we don't put any volatility in the income statement, because the income statement here is not concerned. So I have market movements on the asset side of the balance sheet, okay, but I don't have the market volatility in my income statement. Okay, and finally, in March of N+2, we sell our assets for 167. Okay, well, that means there will be a cash inflow of 167. All right, the financial asset that I see here has to be deleted from my balance sheet. Since the book value of my asset is 165, well, obviously I will take out 165. And by doing this now, obviously the value of my financial asset is 0 because it has been sold. And when I sell an asset with a book value of 165, and I sell it for 167, I make actually a profit of 2,000 because I sell the asset for a higher value than the book value. And this profit now is a realized profit because it's based on a sales transaction. And therefore, I put the gain directly in the income statement as a financial gain. Okay, so far, so good. And now comes the recycling. Okay, because here we're talking about a debt instrument. And if I use fair value through OCI for debt instruments, well, when the item is sold or when the item comes to maturity, I need to recycle comprehensive income. What does that mean? That means I have to cancel any OCI amount. So we see here my OCI amount is plus 15. That's why I will cancel 15,000 in OCI. And therefore my OCI now is 0. And those 15,000 is a gain. It's plus 15,000, so we have potential gain. The amount in OCI is now put in the income statement. And this last entry, the entry number 4B, the 15,000, this is what we call recycling. So the amount is taken out of OCI and is put in the income statement. So that in N+2, when I sell the asset, my total profit that I see in the income statement is actually 17,000. Okay. Now my question is, here we do the accounting for 3 periods, N+1, N+2. Very nice. But my question is, what is the real economic profit of this transaction? I mean, over time, not in one financial year, but the whole investment. I buy the asset one day and then I sell it and so on. So what is the economic profit, the real profit of this transaction? Someone tell me. Independent of the accounting, what is the economic profit of this transaction? Yes, Kintran, it's 17. And why? Why is the economic profit 17? How can I see that independent from the accounting? Exactly. Well, that's correct. Well, what happened? I bought the investment for 150. I sold it for 167. So the economic profit is indeed 17,000. Well, that's exactly what I see in the income statement. So therefore, my income statement, economically speaking, is correct and shows the real situation. But it shows that profit only in N+2 because now in n+2, this profit is a realized profit. Anything else we do here before in OCI, plus and minus gains and losses, are only temporary and on paper. Okay, so we do not realize those gains and losses, they are only on paper. So with the recycling at the very end, by putting the 15,000 in the income statement, I achieve that in the income statement, then I show the economic profit. Okay, so when I have debt instruments, I need to do this recycling. However, if I apply fair value through OCI, there is no recycling. Okay, so if I applied the same numbers here on an equity investment, there would be no entry number 4B. Well, this is for political reasons. I will not go into detail, but I simply don't do the recycling. And that means the gain of 15,000 will never hit the income statement. It will remain in equity. It will remain in OCI. Okay, well, the question now is then, where do I put the 15,000? Do I just leave them in OCI? Do I reclassify them to retained earnings, for example? That's also possible. IFRS number 9 does not tell us how to do it. Well, we can assume that most companies would put the 15,000 then in retained earnings directly. Okay, but this is not mandatory. So the fact that for equity instruments, when I use fair value through OCI, remember it's optional. It's only an option. The fact that OCI is not recycled, you can see this as a disincentive to use the option. Actually, the accounting regulator wants companies for equity investments. Remember, I said that yesterday. For equity investments, the accounting regulator wants companies always to use fair value through P&L. After political discussions, this option was introduced. Well, here now you have the punishment or the disincentive if you want to use the option. Because if you use the option, well, some of the gains that you made with your equity investments cannot appear in the income statement. And that obviously clearly is a disincentive to use the option. And that's why here for equity instruments, we do not have recycling. Okay, that's it on fair value through OCI. Questions? Okay, apparently not. Well, it's pretty much straightforward, we could say. Now we look at the third measurement method that exists, amortized cost. So remember, it applies for debt instruments that are SPPI, so simple, and where the business model is to collect contractual cash flows. So in other words, here I'm holding a debt instrument that I want to keep until maturity, basically, because there's no intention to sell the asset. And then we must use amortized cost. So what is amortized cost? Well, I start with the initial recognized amount, so my first balance sheet value, which basically is the purchase price of my financial asset. Then the book value of my asset may decrease because of repayments. Think about a loan that I have, an accounts receivable or a bond. Obviously, there can be reimbursements before maturity, and they would reduce the book value. There's also the amortization of a premium or discount using the effective interest rate method. And as you can see here, this is the reason, or this element is the reason why this method is called amortized cost method. And obviously, I will explain to you how this works using the effective interest method. And last but not least, I need to reduce or account for certain impairment losses, so losses of value, but losses of value that relate to the credit risk only, not to any other risk. And that leads to amortized cost. Okay, so let's see how this amortization here works with the effective interest rate method. So what's the idea here? the idea here is that in my income statement, because here I have a debt instrument, so in my income statement, I will show interest revenue because of this debt instrument. That's why I'm holding it, to earn interest. And I want that in the income statement, the interest revenue that I show is the real economic interest and not just the nominal interest. Okay, and the real economic interest of a debt is the effective interest. That means here I will recognize my interest revenue in the income statement based on the effective return of my bond, not just of the interest rate, the nominal interest rate. Okay, so let's make an example to see how this works. So we buy a debt instrument today at fair value of 980 because, for example, it's a listed bond. The nominal value of the bond is 1,000. The interest coupon is 5%. And the bond lasts for 5 years. And we assume that the whole amount is reimbursed at the end of year 5. Okay, so this is my investment. The first thing is I need to calculate the effective interest rate. Do you know how to calculate the effective interest rate? In financial mathematics, how do we do this? We also use the effective interest rate in investment decision making, except that here it has another name. So there's a method in investment decisions that is based on the same mathematical principle, but it's called differently. It's not called effective interest method. Anyone, any idea? How do we calculate an effective interest of a loan or of a bond or of a debt in general? No. Well, it's based on the discounted cash flow methodology. Okay, so you know, discounted cash flow, what do? I forecast the cash flows of my investment, then I use a discount rate and I calculate the present value. Okay, so here I will do exactly the same thing. I will use the same discounted cash flow methodology, except here what I want is not the present value. What I want is the discount rate that makes that my present value is 0. Okay, so the effective interest is the interest rate, the discount rate that makes that my future cash flows have a present value of 0. Or you could say it's the interest rate that makes that the investment amount, 918, equals the present value of the future cash flows. That's what I'm doing. Okay, so it means in the first step, I need to forecast the cash flows. Okay, today I invest 980, then I'm paid interest. I get 5% of 1,000 every year, which is 50 over 5 years. And at the end of year 5, we assume that the whole amount is reimbursed in one shot. So I get another 1,000. Okay, so these are my cash flows over the next 5 years. And now I'm looking for the interest rate that makes that the cash outflow equals the cash inflows, or that the present value of all of this is 0. And this interest rate here is the effective interest rate. In investment decision making, I call this the internal rate of return. Well, it's the same principle. How do you calculate the internal rate of return? Well, you look at the discount rate that makes the present value 0, or the cash outflows equal the initial investing cash outflow. Okay, so obviously here we need to use Excel, etc., or mathematical calculator to do this. So here, obviously, I did this already. That means here the effective return is 7%. Okay, so if I look at without the calculations, if I look my investment, what is the return? Well, the return is 5% every year. Okay, that's an annual amount. But in addition, I make another 72 euros. Okay, because today I buy the investment for 918, but I will be reimbursed 1,000. So it means I get 5% every year, and one time I get 72. That means I need to allocate the 72 over 5 years because interest rates are annual or expressed in annual values. Okay, so 5% plus 72 euros stretched over 5 years, basically that equals 7%. Okay, so that's how can we explain that my effective return is higher than the nominal return. Makes sense because here actually I buy my bond with a discount. I buy it cheaper than the nominal value, than the reimbursement value. Obviously, I could also buy a bond with a premium. So here, if I paid 1,100, for example, for my bond, my return would be lower than 5%, because I would get 5% every year, but I would lose upon reimbursement. I would lose 100, and I would need to allocate the 100 over the 5 years. Okay. Are we good here with that? Do you understand what's going on? Please, any comment? Are we good here? Okay. All right, so here, effective interest rate is 7%. That means with the 7% now, I can set up a reimbursement schedule for my investment. Okay, so I buy the debt for 980. The first interest payment is 50 at the end of the first year. However, the effective interest rate is not 50. The effective interest rate is 7% on the investment amount, or 7% on the value at the beginning of the period. So 7% of 918, and this is 64. Okay, so what does that mean? That means economically in the first year, I earn 64 of interest, but 50 are only paid. According to my cash flows here, I'm only paid 50. So I earn 64, but I'm only paid 50. So what happens to the difference of 14 here? Well, the difference is added to the book value. So that at the end of the year, as you can see, my book value has increased by 14. The 14 is the interest that I have earned, but that has not been paid yet. And this interest, the 14, is what we call accrued interest. Accrued interest. Because in the income statement, we recognize revenues and expenses when they are economically generated, not when they are paid. So here I generated 14 of interest. They have not been paid, so this is accrued interest, and this accrued interest is added to the book value. Since we are in a world of compound interest, that means also my effective return of the second period increases to 65, because now I apply the 7% on 932. So now I have 15 of accrued interest, and therefore I increase my book value by 15. Okay, and we have a snowballing effect. That means my effective interest increases every year. Okay, and the last time I add accrued interest here, in the last period, the accrued interest is 20. So the last time I add the 20, my book value in total will be 1,000. I remember it's 980 before. Now I add 20. So at the very end, my book value is 1,000, and then I'm reimbursed 1,000, and that means my book value after reimbursement is 0, and we are done. Okay? And here you see, this is the evolution of my book value over time. Here you can see how I amortize the discount. Remember, the original discount is 72 euros, 918 compared to 1000. That's how I amortize the discount, because the discount is added every year in form of accrued interest. The discount is added every year to the book value. And at the very end, the discount is completely amortized, since my book value will be 1000 just before the reimbursement. Okay, so this schedule here, and of course, if you have questions, please feel free to ask them. This schedule here is relevant for my accounting. Okay, so we remember 64 is the interest, the effective interest of the first period. Therefore, let's see how the accounting works. So first, I start on January 1st by buying the bond, and it cost me 918. Okay, so there will be a cash outflow for 980, and I recognize my financial asset for 918. Okay, and it's a non-current asset because here I will keep it until maturity, which is 5 years. At the end of the first year, in the income statement, I will recognize my effective interest. That's the 64 we calculated in the previous table. I will cash in 50, okay, because that is the interest that is actually paid. And the difference of 14, my accrued interest, is added to the book value. And therefore, at the end at the end of the first year, my book value now is 930, what we had in the previous table. Sorry, 32, obviously, what we had in the previous table. Okay, and that's how I move on. And I do this over the 5 years, and at the end of the year 5, well, the bond is reimbursed. Okay, that's the methodology of amortized cost. Any question on that? Apparently not. So why do you think we do not apply fair value accounting on this category? I mean, we have fair value accounting everywhere else. All other debt instruments, all equity instruments are always fair valued. But here, for those debt instruments, we do not use fair value accounting. Why not? What do you think? Why let's put it differently. For this type of investment of financial asset, why are fair value changes not really relevant, to present the real economic situation? Why do I not care about fair values and fair value changes here over time? Any idea? Well, because we are talking about debt instruments that are held until the very end, that are held until maturity. Okay. And that means here, what's relevant for me for this bond are only the contractual cash flows, because I will hold until maturity. What happens in between, the fair value goes up and down, etc., is not relevant. I don't care, because I still sit there and get my cash flows. Unless for one situation, what can happen that I do not receive my contractual cash flows? What can happen that I do not get 50 every year and 1000 at the very end? Hello, anyone? What can happen that I do not receive interest and the reimbursement? bankruptcy is one proposal. Okay. Nothing else. Indeed, bankruptcy. Obviously, the issuing company or the client company can go bankrupt. That means when I use amortized cost, I do not care about fair values. Okay. However, I need to care about bankruptcy, or in other words, I need to care about the credit risk. Okay. And this actually is the last element that is part of amortized cost, because I need to account for impairment losses for credit risk. So here we have to be careful. Only for credit risk, not for interest rate risk. Obviously, when I buy a bond, market interest rates go up, well, the market value or the fair value of the bond decreases. But this is not relevant, remember, because here we do amortized cost and fair values are not relevant in amortized cost. However, the credit risk is relevant. Okay, so therefore, here are the rules in IFRS number 9, how to consider and how to account for the credit risk only. And here, with the introduction of IFRS 9 several years ago, the approach changed fundamentally, because now in IFRS 9, impairment losses for credit risk are measured using a so-called expected loss model, compared to what we had previously, an incurred loss model. So just one sentence to tell you the difference. In an incurred loss model, actually you have to wait until a loss event happens before you account for an impairment. Okay, so in other words, I make a loan, for example, to a client, or I buy a bond. Okay, as long as the client pays everything that is due, okay, well, there is no loss event, and therefore I will not consider, or I will assume, the credit risk is zero. The incurred loss here is zero. There is none, and therefore no impairment. However, in IFRS 9, we have a new approach, and also this is the result of the latest financial crisis, 2008, 2009, 2010. Now we have to use the so-called expected loss model. That means I do not wait until there is a loss event. I need to account for an impairment loss from the very beginning, right from the start, even though the client still pays everything on time. Okay, so there's no default. He's paying the contractual payments, but still I need to consider already an impairment loss on my financial assets. Why? And why this change? Well, because I know by experience that although, let's say, I have 100 clients, 100 loans, all those loans today, they look very good. All clients pay on time, etc. There's no problem whatsoever. But I know by experience that whatever 1% of those clients will default. I know this based on my historical data. I do not know yet today which client will default, because they're all looking good and they're all paying. But I know in this group, in the portfolio, there will be losses. Okay, so instead of waiting until I see the losses, I anticipate them right from the beginning. And this is the expected loss. Okay, how do I do this? Well, actually, my financial assets, I need to, and obviously here we're talking about only debt assets. My financial assets, I need to put them in 3 categories. Officially, they're called buckets. Bucket 1, 2, and 3. As you can see, going from 1 to 3, the credit risk deteriorates, increases. The situation of the client gets worse. In bucket 1, well, actually, all financial assets will start in bucket 1. Okay. Bucket 1 means, okay, before buying the bond or before giving the loan, I made a credit risk assessment of my client. After the assessment, I still decided to give him the loan or to buy the bond. Okay, obviously, depending on the credit risk, is it AA, triple B, etc., etc., I will ask for a different interest rate, since the interest rate is linked to the risk. But anyway, in bucket 1, I have all those new loans at the beginning, because it's right after or very close to when I did the credit risk. And obviously, I would not have given the loan if I thought there was, default was certain. No, I did this analysis. I think, okay, there's a certain probability, but still, I made the loan. In bucket 1, we assume that the credit risk did not change since the inception of the asset, or the risk is very low anyway, because we are talking about a AAA bond. Okay, so I made the analysis 9 months ago or 3 years ago, it doesn't matter. If the situation of the client did not deteriorate since then, well, the asset is in bucket 1. Okay, therefore, I still need to do an impairment. How do I calculate it? I calculate the expected loss, EL, expected loss for 1 year, which means basically I calculate an impairment which is based on the probability that the client goes bankrupt within the next year. So expected loss 1 year means probability of defaulting within the next year. That's what we're doing here. So 12 months probability of default, which obviously is relatively low because it's only for 1 year. You imagine if I have a 20-year loan, the probability of default over the next year is rather low. You have to be careful. Expected loss 1 year, again, says only something about the probability of default within the year. It does not mean only my loss or losses that I have in the first year. Obviously, if the client goes bankrupt in the first year, I lose all the cash flows of this contract, not only for the first year. But the 1 year here means probability of default in the first year. Okay, so all assets are in bucket 1 at the beginning. If the credit risk has significantly increased since then, and we have a high risk level, now my financial asset moves to bucket 2. That means, okay, since the inception, the credit risk has increased. Therefore, now we are in bucket 2. Now I need to calculate my impairment loss based on the expected loss to maturity. That means here I calculate the probability of default over the remaining maturity. And you can imagine if the remaining maturity is 10 years, well, this expected loss here over maturity is much higher than the expected loss just over 1 year, because the probability of default is much higher. So that means in bucket 1, I have a very small impairment loss. In bucket 2, the impairment loss increases. Okay. And my loan or my financial asset moves to bucket 3 when there is actually a loss event. Okay, so that means here in bucket 3, well, the client did not pay something he was supposed to pay. So something really happened. So there was an interest payment and he didn't pay. Okay, so here we have a loss event, which means basically here in bucket 3, we are not talking about an expected loss anymore. We are talking about an incurred loss. Okay, so bucket 1, bucket 2, we have an expected loss. Bucket 3, in reality, we are in the same situation as before. We have an incurred loss because something really has happened. Okay, so if I move to bucket 3, I need a more sophisticated approach. That means I need to forecast the cash flows that I think I will receive after this loss event. And then I discount those cash flows, and this is the value I will get back. And then I need to account for an impairment between the book value today and the lower value I will get because of the loss event. Okay, questions on that, please? On the expected loss model. For those of you working in a bank, is that what you're using already in Vietnam or not? Are you still in an incurred loss model? You don't know. Okay. Let's do an example on this. So entity A purchases a debt instrument with a fair value of 1,000 and measures the debt at amortized cost. Okay, the instrument has a nominal and effective interest rate of 5% over the contractual term of 10 years. And everything is payable at the end of the year. At the end of the first year, the fair value of the debt instrument has decreased to 950 because of changes in market interest rates. The entity determines that there has not been a significant increase of credit risk since initial recognition, and that expected credit loss should be measured at an amount equal to the 12 months expected loss, which here we suppose is 30. And then on January 1st, the entity decides to sell the debt instrument for 950. Okay, so roughly, how does the accounting go before I show you the balance sheet and the income statement? So I buy the investment for 1,000. That's my first balance sheet value. At the end of the year, I will cash in 5% of interest. At the end of the year, also the fair value is 950. But do I consider this fair value? I buy for 1,000. At the end of the year, the fair value of the bond has decreased to 950. Is this number 950 here relevant for my accounting? Hello? All right. No, it's not relevant. That is correct because we are using amortized cost and not fair value. And the fair value here is not related to a credit risk, then it may be relevant, but to market interest rates. So I don't care about the 950, but I have an expected loss of 30. And then at the beginning of the following year, I sell for 950. Okay, so I have a cash outflow of 1,000 and I recognize the financial asset. At the end of the year, I have my interest revenue, and remember here, nominal interest rate equals effective interest rate, so no accrued interest, and we are good. But I also need to account for the impairment loss for 1 year, which is 30. Okay, so it means it's a very prudent, a very conservative accounting approach. Because from the very beginning you consider losses. The idea is to avoid, especially in the banking sector, that in terms of financial crisis or financial difficulties, such as COVID, why not? The banks accumulate a lot of losses in one shot, because everybody pays on time. Then comes the crisis, and then okay, suddenly I have a very high amount of losses if I am in an incurred loss model. So here in the expected credit loss model, I account for the impairment loss already from the very beginning. And that means when the crisis comes, well, the loan is already partially impaired. And that means the impairment losses in times of crisis are not as high anymore. Okay, and then at beginning of year X1, we sell the bonds for 950. So I have a cash inflow of 950. My financial asset book value is 970 and needs to be taken out. So here I sell my asset that has a book value of 970. I sell it for 950. That generates obviously a disposal loss of 20. But you see, it's the same thing. Since I anticipated already a loss of 30 in the previous year, well, now in year X1, the loss is not as high. So it doesn't hurt me as badly as it would have been without the impairment loss in the first year. Okay. So we have to account for expected credit losses when I use amortized cost. Okay, but very important, I also need to use the expected credit loss model for debt instruments that are fair value through OCI. Okay, so although I fair value those items, I still need to account for the expected credit loss. Also, I need to do both. Okay, so far so good. And let's do a case, an exercise, which is the, where are we? Not here. The following one. Here we are, exercise number 5. So we have different financial instruments. We need to determine in which category we put them. And obviously, we also need to find the accounting solution. Okay, what I propose here is that I let you work a little bit on those exercises, and to do so, I put you, if I find where to do this, here we are. I put you in some groups, okay? So I give you, I don't know, 15 minutes, all right, to work on this exercise, and then we discuss the solutions. Are you okay with that? And we are 29 people. So I create, well, 7 groups for 15 minutes. Okay. So 15 minutes to work on exercise number 5. Can you do that? Someone, please give me a reaction here. Okay. Then here you go. And I see you in 15 minutes.
You are currently the only person in this conference.
So then let's see for this exercise how we did it, or how you did it. I will share my screen. Okay. Okay, I turn it up a little bit. I hope it's better now. So exercise number 5. The Placeit company made the following investments during the year. We bought money market funds for 15,000 euros. They were bought at the end of November with the objective of generating a profit from short-term excess cash. They are considered both very liquid and low risk, and the market value is 16,000 at the end of the year. Okay, so in which measurement category do we classify this investment? Amortized cost, fair value through OCI, fair value through profit and loss. What do you think? Which measurement category? Yes, indeed, fair value through profit and loss, because it's a debt instrument with a short-term purpose, so it's fair value through profit and loss. Okay, that means in terms of accounting entries. Okay, well, I put my cash position here. But I spend for the accounting entries, I spend 15,000, so minus 15,000 in cash, and I get a financial asset short term, so it's a current asset for 15,000. That is at the acquisition date. Okay, at the end of the year, my investment has a value of 16,000. Okay, so that means I need to increase the value of my investment by 1,000. Okay, and the 1,000 are recognized as financial revenue directly in the income statement. Okay, fair value and fair value goes directly in the income statement. Well, I think that's not really a problem here, since this is the easiest category that we can have. Unless you have questions, I move on. Then we check the second investment. We have 3,000 bonds from company B. Okay, and we buy them at 45 euros for each bond. The face value or nominal value is 50. The nominal interest rate is 6%. The effective interest rate is 8.54%. The redemption price is 50 euros, and they will be redeemed in 5 years. That means at the end of N+4. At the end of year end, the bonds are trading at 40 euros, following an increase in interest rates, and the expected loss over 12 months is 900. And Placeit intends to hold the bonds until maturity. Okay, so what's the measurement method we use here for those bonds? Hello, hello. What's the measurement category for those bonds here that we hold to maturity? Well, it is a non-current asset, that is true. But how do I value it? It's the measurement category. Do I use amortized cost? That's not the question. The question is, how do I measure? How do I value them? Do I value them with amortized cost, fair value through profit and loss, fair value through OCI? That's the question. Amortized cost, indeed, okay, because it's a debt instrument, it looks normal, so SPPI. And since I hold it to maturity, the intention is to collect the contractual cash flows. Okay, then let's do the accounting for this. Okay, so first I buy the bonds. I buy 3,000 bonds for 45 euros. All right, that means I have a cash outflow of 135,000. Okay, and I get a financial asset that is in the non-current section because it's long term. Okay, here we are good. And then I need to apply amortized cost, obviously. That means before I do this, I need to establish a reimbursement schedule. Okay, so here is the reimbursement schedule. That means I have the investment amount of 135. The effective interest rate is 8.54, is already indicated in the exercise. So it means the interest revenue of the first year, or at the end of the first year, is 11,529. Okay, I am paid interest of 9,000, 6% on each bond, or 6% on the nominal value of each bond, which is 9,000. And the difference between the interest earned and the interest paid is added to the book value. Okay, so 11,529. That is the number I need to remember here. Sorry, because it is the interest revenue. Okay, so at the end of the year, I recognize an interest revenue of 11,529. I cash in an interest revenue of 9,000. Okay, and the difference between the two is added to the book value. So my book value here will increase by 2,529. And this, what we have here, the 2,000, is what we call accrued interest, added to the book value. So that at the end of the first year, my book value is 137. Sorry, 137.29. Okay, so far so good. Then we have the information that at the end of the year, the bonds are trading for 40 euros. Okay. Do we consider this information? Well, the value here is the market value, so the fair value. Okay, and here we are talking about amortized cost. And in amortized cost, we do not consider the fair value, in particular, since the fair value relates to an increase in interest rates. No, it's 9,000, no? Because we have 3,000 times 50 is 150,000 in total. 3,000 times 50 is 150,000. 6% of 150,000 is 9,000, not 900. It's 9,000. However, 9,000 is the interest. Then we have, in addition, an expected loss of 900. And I need to account for this in addition. So maybe I should change the numbers here. Let me do this right away. So assuming it's, well, now I leave it, but I will change it for next year. we have an expected loss of 900. Okay, so that means in addition, I need to account for an impairment loss of 900. And the impairment loss obviously will be deducted from my investment amount. So that's the expected loss, the impairment loss, which is 900. But good idea, I will change the amount for next year so that there's no confusion between the interest and the impairment loss. That's better. Okay, that's amortized cost, including the expected loss. Questions on that? Probably not, I guess. Then we have the third investment, which is a share investment. I buy 10,000 shares of company A. Okay, they represent 18% of the company's equity traded on the stock exchange. The price was 5,000. At the end of the year, the value is 5,300, and we intend to maintain the stake in company A. Okay, so first of all, since the shares here represent 18% of the company's stock, that means the 18% do not lead to control, apparently, so no consolidation, do not lead to significant influence, because usually significant influence starts at 20%, so no equity method. And that means here, indeed, we have only a financial investment. Okay, and we plan to maintain the stake. So it means it's a long-term investment. So I start with paying 5,000 for this investment, and I recognize a non-current financial asset, 5,000. And the question is, what is the measurement category that I use for this? What do you think? Amortized cost, fair value through profit and loss, or fair value through OCI? So we have one proposition here, fair value through OCI, which is correct, but is this mandatory? Do I must use fair value through OCI? Or is there also an alternative? Hello? Is fair value through OCI mandatory? Yes or no? No, it's not mandatory. Well, we could use fair value through profit and loss, or we can use fair value through OCI. Since here it's a non-trading investment, so I want to hold it so it's not for speculation, I have a choice, fair value through profit and loss or fair value through OCI. So here, assuming we use fair value through OCI, okay, at the end of the year, the value is 5,300. That means I need to revalue my investment by 300, and I put the gain directly in OCI. Okay. Also plus if we use fair value through OCI. No? Okay, if I use fair value through profit and loss, well, the 300 here would go in financial revenue directly. Okay, so far so good. Now we have a derivative financial instrument, a currency future. So in October N, we enter for cost of 0 in a currency future contract in which Basic buys $1 million for 1 million euros. So we pay €1 for $1, and in 9 months. And we speculate that the dollar will appreciate, will become more expensive compared to the euro. And now we have two alternative scenarios, 1 and 2. The first one, at the end of N, the dollar has indeed appreciated and the conditions of the currency future are favorable to Basics. The future has now a value of 50,000. So that's the first scenario. Okay, how do we account for this? But first of all, when I buy the future, when I enter into the future, it has a value of 0. That means I may account for the derivative, but the first value is actually 0. Well, because for most derivatives, when I engage them, there is no payment to be made. A future or a swap, for example, a forward rate agreement and so on, we only pay a contract, so there's no cash flow. However, we do have some derivatives where there is a payment. Do you know a derivative where I need to pay something in the very beginning? Or even over time? Any idea? A derivative where I need to pay something. In a swap, well, depends on what swap. If we talk about a currency swap or an interest rate swap, well, interest rate swap, you don't pay anything at the beginning, okay? But obviously you pay something during the contract, because we exchange interest rates. But if we talk about a credit default swap, for example, an insurance against credit risk, well, here probably you pay at the very beginning because you need to pay an insurance premium, more or less, on a regular basis. And it depends on how the contract is. Maybe the first payment is at the beginning. So swaps is not necessarily the first example I would use, but potentially yes. But there's another derivative where I actually need to pay at the very beginning. That's for sure. For swaps, it's not sure. It's possible, but not certain. Depends on the contract. But here for this other derivative, it's clear. A premium, yes, but what is the derivative for which I need to pay a premium? Yes, correct. It's options. For options, it's different. There I pay something in the beginning, and my first balance sheet value would actually be the premium that I pay. But here for currency future, I pay nothing. So the first value is 0. And as I said yesterday, for derivatives, we are always in the category fair value through profit and loss. Okay, by definition, there's no other possibility. Okay, so fair value through profit and loss. In this scenario here, at the end of the year, the future has a positive value of 50,000. Because here the movement is in the way I was anticipating it. It is now favorable for me. That means the future has a positive amount or positive value of 50,000. Okay, so my starting value is 0. And I need to increase that by 50,000. So to make it a positive value. And this is a gain, and the gain goes directly in the income statement because we are fair value through profit and loss. So here I have a fair value gain on derivative for 50,000. Okay, so although my first balance sheet value is only 0, so that means on the balance sheet I don't see the derivative. In my accounting system somewhere, obviously I need to track that. So I need to write down that I do have a currency future with the conditions and so on. I need to track that, but it would be outside of the accounting. At the end of the year, I see the fair value in the first scenario. In the second scenario, actually, against expectations now, the dollar has not appreciated but depreciated. That means now, actually, if I wanted to buy $1 million, I would need to pay less in terms of euros. Therefore, the contract for me is unfavorable. It's a bad contract for me. And the future has now a value of 30,000. But here we have to be careful because now, since the future is unfavorable for me, That means actually the future is now a liability for me. If we executed the future today, I would lose 30,000. I would need to pay 30,000 to the winning party. Actually, most future contracts are a bet. Okay, one side is winning, one side is losing. If it's a swap, an option, a future, and so on, doesn't matter. And many derivatives are not physically executed. Okay, so what do I mean by physically executed? You see here we have a future on $1 million. Okay, but when we execute the future here, we will not actually transfer $1 million. But what happens is I have a settlement of the derivative, and the settlement means the losing party is paying something to the winning party. So here in my first scenario, I was on the winning side. That is like a claim on the loser. The claim is 50,000, therefore any claim for me is an asset. But in the second scenario, I'm on the losing side. That means if we executed the future contract today, or if I wanted to sell the future contract today, actually I would need to pay something to the other party. And therefore, the derivative now for me is a liability. But actually it's more obviously a current liability because it's short term. And the value is 30,000, but that means I would need to pay 30,000 to someone if I wanted to get rid of the contract, or I would need to pay 30,000 to the winner, my counterpart. Okay, and that means here for the company in the income statement, it would be an expense of 30,000. Okay, and in other words, a fair value loss on derivatives. Okay, so that means derivatives are the only financial instrument where actually you can, or the asset or the derivative can change sides in the balance sheet. A derivative, the same derivative, can be an asset if I'm on the winning side, or can be a liability if I'm on the losing side. Okay, and the same derivative obviously can change sides. If I'm holding a derivative over many, many years, well, today it's maybe an asset, but tomorrow it may be a liability, depending on how the market parameters change. Okay, that's the only asset where this can happen. Okay. Other than that, assets are always assets, liabilities are always liabilities, but derivatives can change sides. Okay, are we good? Questions here on this exercise or derivative accounting in particular? A little bit later, we'll see hedge accounting. Okay, that's an exception to this accounting treatment here, but for standalone derivatives, it applies as I said. You're good? No questions? Okay, well, then we can move back to the slides and talk about financial liabilities. So that means basically we move to the other side of the balance sheet from the asset side where we had those categories, amortized cost and so on. We move over to the liability side. And here we have an important question to raise. The first one is, well, we have, or IFRS number 9 applies to financial liabilities, but it does not apply to equity. That means we need to make a distinction on the right-hand side of the balance sheet between financial liabilities and equity, debt and equity. Well, actually, it's the same distinction that we use already on the asset side, because remember, the different measurement categories apply depending on if my asset represents a debt or if my asset represents an equity instrument. Okay, therefore, what are the rules in IFRS to know if something is debt or equity? So here I show you this relating to the right-hand side of the balance sheet, but we have the same rules on the left side for the assets. So when is something a debt? Well, a debt is given when the issuing company has an obligation to pay ongoing compensation, so usually what we call interest, but it may have any other name, or when there is an obligation to repay until maturity. So in a regular debt, at some point you need to reimburse, okay, and at some point you need to pay compensation for, let's say, the credit risk, either every year or, you know, some contractual terms to pay something. Though that's one approach. Or you could also say something is equity when the investor is exposed to equity risk. That means the risk of losing everything, for example, like in a share investment. Okay, let's here also look at a case, in particular the exercise number 6 that we have. Different situations, and we need to decide if we have liabilities or if we have equity. So first one, okay, well, the company A issues ordinary shares to the public. Ordinary shareholders are not entitled to a fixed return on their investment. Okay, so no. And they receive the residual left over after all liabilities have been settled. Okay. Now, question is, are the shares issued by company A, are they debt or equity? So first of all, question, what are ordinary shares? Or more precisely, what are the rights that I get when I have ordinary shares? Any idea? What are ordinary shares? What are ordinary shareholder rights? Any idea? What are ordinary shares and ordinary shareholder rights? Yes, ordinary shares and common shares is the same thing, yes. Yes, voting right included here. Yes, dividend right. That's true. Well, these are the most common ones. Usually we can add a third right, which is the right to get information, because in the shareholder meeting you can ask information. And the last right is liquidation right. Access, we could say. What does that mean? Well, when the company is liquidated, all assets are sold. With that money, all the liabilities are reimbursed. And if after reimbursement of all the liabilities, money is left over, then this residual amount is distributed to shareholders. Obviously, this last right on liquidation access is only hypothetical and potential, because we know that in most liquidations, well, actually, there's not already enough money to reimburse all the debt, let alone reimburse the shareholders on anything. So mostly they don't get anything, but hypothetically they could. Okay. So that's an ordinary share. Okay, and this last liquidation excess is actually what is written here. The residual leftover after all liabilities have been settled, well, that's just a regular shareholder right. And as a shareholder, obviously, you are not entitled to dividends. You have a right to receive dividends, but only when there are profits. So there's no contractual liability to pay you dividends every year. Okay, so knowing all this information for investment A, and I will put a poll. Okay, is investment A equity? That's the question. Yes or no? What do you think? Is investment A equity? Equity, yes or no? Well, indeed, here it is equity, okay, because we do not have an obligation to pay dividends, no obligation here. Do not have an obligation to reimburse upon maturity. Well, anyway, shares do not have maturity. And therefore, clearly, in the first case here, we are in a situation of equity. So company A issues those shares and they are equity. Okay, so far so good. Let's see for company B. Company B issues preference shares to the public. Preference shareholders are entitled to a non-cumulative dividend of 5% every year, and they rank ahead of ordinary shareholders in the winding up of the company. The preference shares here are not redeemable. Okay, so what are preference shares? Anyone? Any idea? What are preference shares? Well, I explained the non-cumulative a little bit later. Let's see in general what are preference shares first. Huh? What's the difference between preference shares and ordinary shares or common shares? Any idea? Preference shares, well, sometimes the Americans call this preferred. Not necessarily exactly the same, but goes in the same direction. Preference shares, preferred shares versus ordinary shares. Any idea? Means for preference shares, you have a preference. Yes, exactly. Hong Huin, that's right. You have a preferential treatment in one area. Okay, so let's put it this way. Preference in one area, but in order to get this preference in one area, you have a disadvantage in another area. Well, when we say area, we're talking about the main shareholder rights. Remember, voting right, dividends, information, liquidation. Okay, so you have a preferential treatment in one area, in one of those 4 areas, and you have a disadvantage in another area. So the most common thing here is a non-voting preference shares. So you see here preference. So you see here the disadvantage, you have no voting right, but the advantage is you get higher dividends. So dividend bonus, but no voting right. Okay. So here, preference shareholders are entitled to a dividend of 5%. So basically, your dividend is 5% every year if there are dividends paid. Okay, so it's not a random amount, it's always 5% of your investment. However, the dividends are non-cumulative. So what does non-cumulative mean? It means that if in 1 year I am not paid dividends because nobody gets dividends, in the following year I don't catch up with those lost dividends. So if in 21 there are no dividends paid, in 22 I get only dividends for 22. I do not get dividends for 21 and 22. That means non-cumulative. So if the dividends of 1 year are not paid for one reason or the other, I will not catch up and I lose definitely those dividends. Okay? That's for the non-cumulative. And the preference shareholders have another advantage is in terms of liquidation access, because they are reimbursed earlier before the common or ordinary shareholders. You know that in a liquidation process, we reimburse, or I sell all the assets and then I have a lot of money. And then this money, I use it to reimburse the debt holders' liabilities, but the liabilities are reimbursed in a specific order. So not on a pro rata basis, but in a certain order. There are preferred debt, there's preferred, or there are a priority debt that is reimbursed first, and then actually people stand in line. And first I reimburse everything to the first people in line, and then I move down the line. And as long as there's money left, I reimburse those people. So people are standing in line, okay? And then at the end of the line, we have shareholders, common shareholders. That means here the preferred shareholders, they're just one spot ahead of the ordinary shareholders, but still they come after all the other shareholders. Okay? And the preference shares are not redeemable, no maturity. Okay, so same question here. The preference shares in are the preference shares yes or no? That's the question. What do you think? Are the preference shares equity? Yes or no? Okay. Well, here you see the result, and it's rather split. Okay. Why not? So the people who think it's not equity mean that it is a debt. So why do you think the preference shares here issued by company B are a debt? Because if it's not equity, it's debt. So what do you think, please? Some of the 7 people who said it's not equity. Why do you think it's debt? Well, nothing is coming up so far. Okay, feature similar to that, a fixed amount of yearly dividend. Okay, yes, we do have a 5% dividend. Okay, but the question is there an obligation to pay those dividends? Is there an obligation to reimburse? Well, the answer is no. I have a 5% dividend, but only when we pay dividends. Okay, so there may be years without dividends and I do not get the dividends back. If the company makes a loss, for example, there are no dividends. I do not get the 5% and I will never get it. That means there is no obligation to pay dividends. There's no obligation to reimburse. Okay. Therefore, no obligation, that means it's equity. The fact that you rank ahead of ordinary shareholders in the winding up of the company means, yes, of course, you are in a slightly better position than common shareholders. But does it really matter in reality? Well, no, because in reality, already the last debt holders are not reimbursed. So if you are coming after the debt holders and just before the common shareholders, you still don't get any money. Okay, that means in the end here, we can say that also for B shares, it's equity. Okay, company C issues preference shares to the public. Preference shareholders are entitled to a cumulative dividend of 5%, and they rank ahead of ordinary shareholders on the winding up of the company. The preference shares are redeemable at the option of the shareholder. Okay, so now we have a cumulative dividend, which means if in 1 year I lose the dividends, in the following year I get dividends for 2 years. Or if I lose 5 years of dividends, in the following years I can get dividends for 6 years because they are cumulative. Okay. And the preference shares are redeemable at the option of the shareholder. Therefore, we go back. Question: are C shares equity? Question: what do you think? Cumulative dividends in the winding up of the company, preferential treatment to ordinary shareholders, and redeemable at the option of the shareholders. Do you think the C shares are equity? Okay. So here we have a majority of people who think it is equity. So please tell us, someone, why do you think this is equity? Some of the 11 people who agreed that the C shares are equity. Anyone? No. Nobody? Okay, well, so here we have a cumulative dividend. That means I am assured to receive dividend payments, which means company C has an obligation to pay dividends. If I don't pay the dividends this year, I need to pay them in the following years. So there's an obligation to pay dividends. The preference shareholders have an option to ask redemption. Well, if the shareholder asks redemption, company C is obliged to reimburse, because it's an option for the shareholder, it's not an option for the company. So therefore, for company C, well, company C has an obligation to pay dividends, ongoing compensation. company C has an obligation to repay, well, not upon maturity, but upon request. Well, that's similar. Okay. And that means here in the C case here, these shares are actually, where am I? Here, these shares are actually debt. Okay, that means I call them preference shares. Okay, but in reality, they will be accounted for as debt because economically it's debt. Okay, company D, we issue preference shares to the public. Preference shareholders are entitled to cumulative dividends. They rank ahead of ordinary shareholders in the winding up of the company. The preference shares are redeemable at the option of company D. So not at the option of the shareholders, but at the option of company D. Okay, so cumulative dividends, similarly to C, the only difference is that now it's the company who can ask for redemption. So same thing here. Are the, where are we? E shares, no, D. Are D shares equity? The question, yes or no? Let's do this. Yes or no? Or don't know. Are the D shares equity? Yes, no, or don't know. Okay. So here we have 53% of people who say no. Some people say yes. Some people don't know. Well, what's the solution here? Actually, so we have one feature, cumulative dividend. That means there's an obligation to pay ongoing compensation. That means here it looks like debt. Okay, we rank ahead of ordinary shareholders. Okay, that's not really a distinctive feature. Okay, looks a little bit like debt. Okay, but it's not a real advantage because again, we will not get any money. So we are a little bit better than equity holders, but literally in the same situation because we will not get any money. And the preference shares are redeemable at the option of the company. Well, that means there is no obligation for the company to reimburse. Company will reimburse only when they want to do it. Otherwise, they won't do it. Okay. So it means company D has an obligation to pay interest, but no obligation to reimburse. Okay. Means here, if I look at my two criteria, we are in the middle. There is one obligation, but not the other. Which means actually here it's unclear. So we don't really know. We have one feature that tells me it's a liability because I need to pay ongoing compensation. Okay. On the other hand, well, there is another feature that treats me like equity. So it's unclear. However, we can say that probably it is equity, but it's not 100% sure. So why do I say it's probably equity? Because the accounting standards say that the obligation to pay a dividend alone is not enough to classify this as debt. So in real life, actually, I would need to read all the features of those preference shares, and maybe other features push me in the direction of debt or push me finally in the direction of equity. But again, cumulative dividends alone is not enough to classify this as a debt. So again, here it's unclear, but probably it is equity. Okay, so we cannot finally answer that. Okay, looking at company E. Company E has an obligation to deliver to company XXL as many of company E's own ordinary shares as will equal 100,000. Okay, so I need to deliver shares to the company and they have a value of 100,000. So do you think that this obligation here that I need to account for, is this obligation, is this debt or is it equity? Because I will pay with my own shares. So again, for E, so is this debt? That's my question here. Do I have a debt or not? I have an obligation to deliver shares. Is this a debt or not? And if not, of course, it would be equity. What do you think? Okay, well, we have a majority of people who think that it is a debt. And this is correct. Because there's two ways how to see this. First of all, company E has an obligation to pay. Okay, obligation equals debt. And the obligation is for a fixed amount. Okay, the amount in euro is fixed as 100,000. The number of shares is not fixed. Obviously, if my share price goes down, I need to give more shares. But anyway, the receiving company XXL will receive 100,000 euros. That's for sure. That means also the receiving company is not exposed to equity risk. So I'm not exposed, company XXL here is not exposed to share price risk, because if the share price goes down, I will receive more shares. But anyway, company XXL will receive 100,000 euros. And therefore, this obligation is debt. And the last one is company F issues stock options to company XXL that entitle company XXL to buy 100,000 ordinary shares at €1 each within 3 months. Okay, so the question here, those stock options, are they equity or not? Options, are they equity? Yes or no? The question. Go ahead. I issue stock options. Are they accounted for as equity or not? What do we have? Okay. Large majority says that no, stock options are not equity, which means you would consider them as debt. Okay, well, that tells us one thing, that accounting is not necessarily democratic. So it's not the majority of votes who have always right, because indeed here, well, if it's debt, I need an obligation for the stock options. Is there an obligation by company F to do anything? No, there's no obligation whatsoever. Company F does not need to pay anything. Okay, the only thing is, if XXL exercises stock options, I must deliver shares. Okay, but there's no obligation to do so. There's no obligation to reimburse. And also, company XXL is exposed to equity risk. Because, well, if the share price is below €1, I will not exercise my options and I get nothing. So there's a risk here for company XXL to not getting anything. That's typical equity risk. That means here, when I issue those stock options, they will be accounted for as equity. Okay, not as debt. Okay, 10:15, I propose that we do another 15-minute break. Okay, and we will continue. So we talked about the distinction between debt and equity. I showed you this here on the liability side of the balance sheet, but again, we use the same distinction on the asset side. So when you buy a financial asset, remember, I need also to classify this in debt and equity. Very important, I mentioned this already several times. Here's another example. The classification is not based on the name of the financial instrument, but really we check if there is an obligation or not. And independently how we call items. So here we have an example for Orange, the French telco company. And you see that this company has issued so-called subordinated notes. So usually a notes is a liability, but here we have notes that have no maturity, and the coupon, so the interest payment, could be deferred at the option of the company. So in other words, the company is not obliged to pay those interest. And we see that those subordinated notes in the balance sheet of Orange is classified within equity. It's part of equity. Okay, and here I let you read those slides, but you see that everything is part of equity. Okay, and we had another example, and there was a question on this on the first day. If we look at the balance sheet of Air France, and within the equity section, they have a perpetual. So we could be more precise, a perpetual bond, actually. Usually you call it a perpetual bond. Do you know what a perpetual bond is? Have you heard of this before, maybe? Perpetual bond. Well, it's a bond that has no maturity. It runs forever. That means for the company, excuse me, no obligation to reimburse. Okay, now we have to check in the notes here what are the conditions of the perpetual, but probably there was also no obligation for the company to pay interest. And that's why the perpetual bond was classified within equity. So it's called a perpetual bond, but the economic characteristics make that it's actually not a bond, but it's equity. And therefore you need to classify this as equity. This classification of a bond as equity or of shares as debt, because you can issue shares, but economically they are debt, has also obviously consequences on the follow-up accounting. So for example, when I pay interest, because officially it's called interest, when I pay interest on this perpetual bond, the interest will be accounted for as dividend payments, because the bond is not a debt. The bond here is equity, okay, and that means equity does not generate interest expense, for example. So I would pay interest on this bond here, but because it's called interest, but the interest would be accounted for as dividends. Okay, that was the point on the perpetual bond here that we have, and we see also that in 2020, Air France decided to reimburse this perpetual bond, and therefore it's not outstanding anymore. But again, there is no obligation to reimburse that. And since there's no obligation to pay anything, it's not debt, it's equity. Okay. So far, so good. So we were talking about debt or equity, but excuse me, what can also be the case is that we may have debt and equity at the same time. Okay, so it's not always debt or equity. We can also have debt and equity for so-called hybrid or compound financial instruments. That means financial instruments that have at the same time characteristics of debt and equity. If that's the case, so if I issue a financial instrument that is debt and equity, well, I need to do split accounting, which means basically that from the very beginning, I need to separate the debt amount and the equity amount. Both need to be recognized separately. Okay, so let me show you how this works. Examples that we have are convertible bonds, most common one. You know, convertible bonds, it's a regular bond that pays interest, but the bond investors also have the possibility, the option to convert that into ordinary shares, to transfer the bonds. Or bonds with warrants, basically it's the same thing as convertible bonds, except that in the bonds with warrants, the warrants can be detached and you use them to buy ordinary shares. That means once I do this, I'm a bondholder and I'm a shareholder. Whereas in a convertible bond, you are either you're bondholder or a shareholder. In some countries, you can have redeemable convertible preference shares. Okay. So that means shares with dividend preference and the option to convert into ordinary shares. If they're not converted, they are redeemed. So you see here these preference shares, US style, but you also have them in India or in Japan. They are looking very much like debt. Actually, they have both dividend. Well, they have equity components and debt components. Okay, so when I have a compound financial instrument with equity and debt, from the very beginning, I need to separate the two parts. And how do I do this? Well, I need to split the amount, the issuing amount of the instrument in a debt component and the equity component. And I will do this by first calculating the liability component. Okay, so I have the total amount of the financial instrument. I will deduct the liability component, and what is left over is the equity component. Okay, how do I identify the liability component? Well, I use the discounted cash flow method. Okay, so here's an example. The company issued 2,000 convertible bonds. The bonds have a 4-year term with an interest rate of 6%, and they're issued at par with a face value of 1,000. The interest is payable annually at December 31st, and each bond can be converted into 250 ordinary shares with a par value of €1. And the market rate, interest rate of similar non-convertible debt is 9%. Okay, so several things here. So we issue bond since they are issued at par. That means there is no discount and no premium, which means also that the nominal interest rate of 6% and the effective interest rate of 6% are the same. Okay, and it talks about the par value of the shares that we have here. Does anyone know what the par value is? Here we have the par value of shares. What is the par value of shares? Well, it's the nominal value, the statutory value, the legal value of the shares. Okay. This is the information. So what do I do? So we see one advantage for companies to issue convertible bonds compared to regular bonds is the interest rate, because we see here the convertible bond pays an interest of 6%, whereas a regular bond that is not convertible would pay 9%. Okay, so that means basically the fact that I issue a bond where the investor can make money with the interest and the option, because I can convert and make money with that, leads to a lower interest rate. Okay, however, these bonds are issued at par, and that means people pay me the full value of the bond, although the interest that this bond gives me is lower than a comparable bond. Usually, you know that in bond values, when I have two bonds, one and I issue two bonds, one with 9% interest, the other with 6% interest. Well, usually, if you propose only 6%, you would have to issue the bond with a discount, a lower price. But here it's not the case. People still pay me the full price, 1,000. Why? Well, because actually, when they buy the bond, they're not only buying the bond with 6%, but they're also paying the option that is included, the option to convert. Okay, therefore, what I will do is I will calculate the liability component, and I will do this by calculating the present value of the contractual cash flows. And what are the contractual cash flows? Well, I have the interest payments, okay, every year. So I get 6% interest, and I have the reimbursement at the end of 4 years. And that's important, all this is discounted with the market interest rate, which is 9%. So I calculate the present value of the contractual payments at 9%. And when I do this here, I see that I issue 2,000 bonds with a par value of 1,000. That means there's 2 million of a total par value. Okay. And the present value of the contractual payments is only 1.8 million, because I discount with 9%. Obviously, the interest is calculated based on 6. If I discount with 9%, well, obviously the present value is lower than the par value. And therefore here I have a present value of 1.8 million. So what does that mean here? That means if I issue, or let's put it this way, today the market interest rate is 9%, okay? If I issued a bond that pays only 6%, I would need to propose the bond with a discount and issue it only at 1.8 million. But since my 6% bond is not a regular bond, but it's a convertible bond, I can still sell them for 2 million, and people will pay me 2 million. So why do they pay me 2 million for a bond that has only a regular value of 1.8? Well, because they pay me a premium, an option premium to buy the option. And the option premium here is the difference, is what the people pay me more, which is 194,000. Okay. So remember we said before, when I buy an option, I need to pay a premium. Here I'm selling an option. That means obviously I will cash in the premium. And therefore in accounting, I will cash in 2 million, okay, because I'm selling 2,000 bonds and they pay me 1,000 for each bond. And this amount of 2 million will be splitted. That's why we use split accounting. 1.8 million is the debt part, because that's the regular bond part, and 194,000 is the option premium. Well, the option premium is accounted for in equity, and this premium amount, the 194, is definitely acquired. You know, it's like when you sell an option standalone, you get the premium. Okay, the premium is yours independently if later the investors do exercise or do not exercise their option. You know, that's their choice. They can do it, they cannot do it, etc. It doesn't matter. You keep the premium. Okay, so therefore the premium here is accounted for in the share premium. okay, and is not moving anymore. That is split accounting. Okay, so very important. I take the contractual cash flows of the liability, but I discount them with the market interest rates for regular bonds without the conversion option. Do you have questions on that so far, please? Anyone? Nope. Okay. Then we continue. Now these are my accounting entries when I issue the bond. Okay, now we do the follow-up accounting because remember it's a convertible bond and therefore different situations may happen in the future. First situation, well, nobody converts. Okay, why not? No bond is converted. That means at maturity, the bond will be reimbursed. Okay. But remember, when I have a debt, like here, well, debt is valued either at fair value through profit and loss or at amortized cost. So most debt is measured at amortized cost. That means here on the 1.8 million, it's a debt. I use amortized cost. And we remember for the amortized cost method, I use the effective interest rate. That means for this debt here, I need to prepare the same schedule that I did for my financial asset. It's exactly the same principle. And the effective interest rate here is 9%. It's the market interest rate because that's the one we used actually to calculate the original debt amount. So here we have a debt that's like issued with a discount of roughly 200,000. That's what I see in debt. So therefore, the interest expense of the first year is 162,000, 9% of the investment amount. So in the first year, I am paid 6% because that's the nominal interest rate. I'm paid 120,000 in interest. I economically earn 162. That means 42,000 is my accrued interest. The accrued interest is added to the book value of my debt. So at the end of the first year, the book value or carrying amount of my debt is 1,848,000. And that's how I amortize over time the discount. So every year I'm paid interest. The economic interest is higher. Therefore, I have accrued interest. The accrued interest is added to the book value. And like the asset example, at the end of year 4, because here my bond has a 4-year time, at the end of year 4, well, my bond has a book value of 2 million. So amortized cost, exactly the same on the asset side, on the liability side. So that's why here, when we assume we do a redemption, the book value actually of my bond now is 2 million. Because I added all the accrued interest. We are just before the redemption date, and now we reimburse. Okay, that means there will be a cash outflow of 2 million, and I will reimburse the bond for 2 million. Okay, which means for the investors, well, they paid 2 million in the beginning. They are reimbursed 2 million, okay, and they get some interest in between. But obviously, they lost their share premium because here they bought an option, but they did not exercise the option, and therefore the premium is lost. And obviously, if they had bought a bond without the conversion option, their return would have been 9%, but because they do this, they have only return of 6%. Okay, first possibility, redemption of the bond. Second possibility, at maturity, all the bonds are converted. Okay, why not? All right, so remember the bond conditions here. I can convert, so there are 2,000 bonds. Each bond can be converted into 250 ordinary shares, and the ordinary shares have a par value of €1. Okay, so 2,000 bonds, 250,000 shares. So if people convert, that means first of all, there is no cash movement because I will not reimburse this debt. I will convert it into equity. That means the debt will disappear, but in exchange, we will issue new shares for a par value of 500,000, 2,000 times 250 times 1, because that's the par value. So 500,000 goes in the share capital, and the difference between the total amount and the par value of those shares is accounted for in the share premium, okay, which here is 1.5 million. Okay, well, that would be the conversion at maturity in the end, when everybody converts. We can also have a situation where the bonds are converted before maturity. So, for example, at the end of year 2012, okay, so that means we have to go to our table. We have to check what is the book value of my debt at the end of 2012. And we see here the book value is 1.894 million. Okay, well, that's exactly what I see here. So just before the conversion, I have a book value of 1,984,000. Now we convert. That means once again, there's no cash flow because I'm not reimbursing. However, the debt will disappear at the book value. Share capital will increase because everything 2,000 bonds converted in 250 shares with the par value of 1. That means the share capital increases by 500,000. And once again, the difference between the total value and the par value is the share premium. Okay, so there would be 1.3,094,000 as a share premium. Okay. Questions to that? Please. Split accounting. So from the very beginning, if we have an instrument, we issue an instrument that has a debt and an equity component, I need to separate them. Very important, the separation is only on the equity and liability side. I don't do that if I'm on the asset side. Because remember, if I'm on the asset side and I buy a convertible bond, it's a debt instrument that is not SPPI. And that means the whole debt instrument, no splitting, the whole debt instrument on the asset side is treated as fair value through profit and loss. So I do the split accounting only on the equity and liability side, not on the asset side. Okay. And here we have one example of orange. So perpetual bonds redeemable for shares. Okay, so they can be redeemed at the holder's request. They can also be converted and so on. And that's why they are subject to split accounting. Okay, and here we see the amounts basically that they have. So big part here we see, well, here something was converted or reimbursed, but other than that, we see that roughly it was for 1 billion, more or less, or more than a little bit more than 1 billion. The amount of which 822 million were recognized in debt, and 196 was the option premium that was recognized in equity. Okay. Questions on that, please? No questions. Okay. So as I mentioned already earlier, for financial liabilities, the measurement situation is a little bit easier. And we can say that most financial liabilities are valued at amortized cost. Okay, that's the standard measurement. But there's also the possibility to use fair value through profit and loss. So this category exists also mostly for trading liabilities. If you have a trading speculative possibility, then you can do fair value accounting. But even so, for non-financial companies, it's very rare that they use fair value through profit and loss. It's marginal. And even in the banking or in the insurance sector, obviously they have a little bit more liabilities at fair value through profit and loss, but still the biggest part of liabilities is in amortized cost. Okay, and one thing is, when you use this method here, well, you account for the change in your own spread, your own credit spread, because remember, liabilities are valued at discounted cash flow. For discounting a cash flow, I need a discount rate. Well, if I'm talking about my liabilities, I use as a discount rate the interest rate that applies to my company as of today, okay, because we are fair valuing that. So if my company goes better than in the past, situation has improved, that means my credit risk, my own spread, decreases. When my credit risk decreases, the interest rate decreases. When the interest rate decreases, I will discount the cash flows with a lower interest rate, and that means the present value of my liability, the fair value of my liability, will increase. And obviously, having a liability increase is bad news for me. And since we are in the category fair value through profit and loss, well, that means the increase of the liability will lead to an expense or a loss in my income statement, which means my situation improves, but that leads to an accounting loss. And vice versa. If my situation deteriorates, that means my credit risk, my credit spread increases. That means my interest rates increase, my discount rate increases. Therefore, the present value of my liability or the fair value of my liability will decrease. That leads to an accounting profit. Well, that's a little bit unusual. And that's why for this category, we do fair value through profit and loss, except if a fair value change relates to our own credit spread. In this case, the gain or loss goes in OCI, not in the income statement. Okay, so therefore, in the end, a deterioration of my situation will not lead to an accounting profit in the income statement. However, it will lead to a gain in OCI and vice versa to a loss in OCI. Okay, well, basically, that's it. So tomorrow we don't have class. We will meet again on Tuesday. And what I want you to do is to prepare the exercise number 7 for Tuesday. Okay, please, exercise number 7. So what do you have to do? Well, actually, we are talking about real financial instruments that have been issued by Air France. And there are 3 instruments. So you have half a page, 3/4 of a page with the description of the instrument. 3 instruments have been issued. And with the information provided, you should indicate if you think if instrument 1 is debt or equity or maybe both. Okay, so give your opinion for the 3 instruments, if they are equity, if they are debt, or maybe both, and indicate the appropriate accounting treatment. So here we're talking about instruments that are issued. So we are on the equity and liability side, not on the asset side. Okay, can you please prepare this exercise number 7 for Tuesday, and then we will discuss the solution. Okay, that means we are done for today. If there are no more questions, then well, enjoy the rest of your Sunday, as will I, and I see you again on Tuesday at the usual time. Okay, thank you very much. Bye-bye.